I'm here today to set the record straight on pricing. In most organizations, the method used to set prices is wrong, and everyone knows it. The obvious consequence is that products and services are regularly overpriced, which drives away business, or underpriced, which leaves money on the table. And of course, neither's good for profitability. But the really bad news is that the mispricing of products and services is a symptom of a deeper problem. A problem that causes ongoing conflict between individuals and departments within your organization. And a problem that results in bad decisions being made regularly by otherwise good people. Today we'll expose the problem with the traditional approach to pricing and then explore a superior approach. I'm Justin Roff-Marsh, the founder of Ballistix and author of The Machine. This presentation is pretty information dense, so I'm going to keep it tight. If you have a question, I'd love to answer it. Just post it in the comments and I'll get to it at the end. Even if you're watching a replay, still post your comment. I'll answer it. My contention is that the root cause of the pricing problem, which I'll expose shortly, is a really bad idea. Most folks understand that this idea is bad, but they act as if it isn't because it makes their lives easier. That's why I'm characterizing this idea as a zombie virus. It's a mind virus that takes up residence in the heads of a particular type of person and causes them to act in a manner that's in conflict with their self-interest. In the short term, these people benefit because it makes decision-making so much simpler. In the long run, the bad pricing decisions they make set them at odds with their colleagues in other departments, and it damages the profitability of their organizations. I'm calling this the cost-plus zombie virus because these folks have adopted a cost-plus approach to pricing. The idea behind cost-plus pricing is that you can calculate the price of a product by summing all of the costs incurred in its production and fulfillment. In due course, I'll explain why cost-plus pricing is such a bad idea and expose the bad assumption that underpins it. But first, let's review how cost-plus pricing works, or at least how it's supposed to work. In this diagram, I'm assuming that the pricing process starts with a quote request, but the process is exactly the same if you're setting a price for a stock item. There are three inputs to the pricing process. There's a bill of materials, basically a list of parts and other inputs. There's a routing. This is a sequence of operations required to produce and fulfill the customer order. And then there's the desired margin. We could think of this margin as the cost of the business owner's capital. From the bill of materials, we calculate the raw material cost. From the routing, we calculate both the direct labor and the overhead costs. In both cases, we're allocating a proportion of total labor and overhead cost to this particular product. And from the desired margin, we calculate the unit profit we would like to earn. Summing raw material and direct labor costs gives us what's commonly known as COGS, the cost of goods sold. And summing the overhead allocation and the desired profit gives us the necessary markup. Then obviously the price of the product is the cost of goods sold plus the markup. The wonderful thing about the cost-plus pricing process is that it's deliciously deterministic. A junior person in your accounting department with a passion for Excel and only junior high-level math can build a model to accurately calculate the price of all your products and services. And by accurately, I actually mean precisely. Now, if you persevered with math through senior high, you might remember that accuracy and precision are not the same thing. Precision refers to the resolution of a result. In other words, to how many decimal places can it be expressed. Accuracy is about truth. In other words, does the result of a calculation accurately reflect reality? This distinction between precision and accuracy is important. To see why, let's consider what happens to the price that's generated by the cost-plus process. The junior person in your accounts department would like to think that the price they generate is presented to the potential customer who responds immediately by generating a purchase order. In reality, the quotation's provided to a salesperson who's reluctant to present it in its current form to the customer. That triggers a series of negotiations between your pricing person and your salesperson, and ultimately between the salesperson and the customer. The result of these negotiations is that the price is revised until a deal is struck, and then the customer generates that purchase order. So now we've taken a precise number generated by a deterministic pricing process and modified it with unstructured negotiations performed by three parties with different incentives. one who wants the highest possible price, another who wants to pay as little as possible, and an intermediary who's happy for the deal to get done at just about any number. Not surprisingly, this is not the best possible approach to setting prices. But worse still, this larger process actually serves to create perpetual conflict between your accounting and sales departments. And this conflict results in the development of organizational scar tissue that makes the reform of the pricing process extremely difficult. It's about time we recognize why cost-plus pricing is a bad idea. It's a bad idea because it's based upon an obviously false assumption. Cost-plus pricing proceeds from the assumption that the vendor sets prices. But this is simply false. The market sets prices. In a free market, no single vendor has enough market power to set prices. And if it does today, given the mobility of capital, it certainly won't tomorrow. Now, this isn't a revolutionary idea. We learn this principle in our very first exposure to economics. And we experience it firsthand every time we buy and sell a car, a stock, or a piece of real estate. However, we choose to act as if we set prices whenever a potential customer requests a quote. But you don't get to cheat reality. The devil will always get his due. If we return to our dysfunctional pricing process, it would appear that we have to choose between two less than desirable options. We could eliminate those messy negotiations and attempt to tune our cost-plus calculus to do a better job of setting prices. And this is exactly what most organizations do. A common argument is that if all vendors price their products on a cost-plus basis, then our calculations should be a reasonable approximation of the market value of the product in question. But this is a very weak argument. For it to be true, all of your competitors would have to have exactly the same cost structure as you. All would need to be processing exactly the same volume and mix of work, and all would need to operate in market conditions identical to yours. The only thing that you can possibly know for sure is that this will never be the case. Cost-plus calculus is more likely to generate prices that are precisely wrong than it is to produce numbers that are vaguely correct. The other alternative is to do away with the formal approach altogether and allow the sales department to set prices via unstructured negotiations. Now, I can't imagine any experienced operator getting excited about this option. A better approach is to adopt the best of both worlds. Create a structured framework that allows for subjective inputs, and then install a process of ongoing improvement, or 𝗼𝗄𝗄, so that the framework learns from mistakes and improves over time. What we need is a framework for estimating prices. A framework because we do need some structure, and estimating because we understand that we don't set prices. The market does, and we can never truly know the mind of the market. Before we get to this framework, let's review the critical differences between these two different approaches to pricing: calculating a price versus estimating market value. If we set prices, all the necessary inputs are objective: raw material costs, machine times, operator pay rates. But if the market sets prices, then we have to allow for some inputs that are subjective in nature. The market's an amorphous creature. No one can read its mind. If we set prices, we can apply a deterministic process, a formula, if you like. But if the market sets prices, we can apply a structured process, but not a deterministic one. An algorithm, if you like, not a formula. If we set prices, then the intuition of operators is noise that needs to be eliminated. But if the market sets prices, intuition is likely to be a critical input. We should design our framework so that it fosters the development of intuition. And if we set prices, our calculations can render a precise single-point output. But if the market sets prices, our estimate must take the form of a range, or to be more correct, a probability distribution. Let me double-click on this crucial idea. The biggest problem folks have in embracing this new approach to pricing is that they're either incapable or unwilling to recognize the distinction between precision and accuracy. If it were true that we set prices, all an estimator has to do is select the correct point on the price axis here. We have every reason to believe that this number is both precise and accurate. But if the market sets prices, the price is not a single point, it's a probability distribution. Once we recognize this, we must acknowledge that accuracy is possible. We can accurately describe the distribution, but precision is not. In fact, if we're selling a custom product or service, our probability distribution starts to resemble a three-dimensional topography rather than a normal two-dimensional distribution. And if we're smart, we can use this additional complexity to our advantage. The key point here is that the pursuit of precision is wrong-headed. If folks in your organization are not prepared to accept this, then it's your job to ensure that they're not allowed to set prices. I think we're finally ready to meet our new pricing framework. The Ballistix value-based pricing framework is an alternative to cost-plus pricing. The essential characteristics are a top-down approach to estimating market value, the generation of a cluster of prices rather than a single number, and the process of ongoing improvement I mentioned earlier. To understand its operation, let me walk you through the process of setting a price. On receipt of a request for quote, the first step is to estimate the market value of the product or service that you've been asked to supply. We're not going to use a bottom-up, cost-plus approach to do this. We're going to estimate the value the market will assign to the product based upon competitive benchmarking. This means we'll consider historical transactions, both ours and competitors, in an effort to make an estimated guess. This historical data can be analyzed and used to build an estimating model. The idea is to approximate the relationship between various product attributes and price. At this point, your costs should not be considered. To build an estimating model, you should determine the smallest number of product attributes that need to be considered to predict the market value of a product. I think you'll be surprised how few product attributes actually have predictive power, even for the most complex of products. I'll never forget a conversation I had once with a Canadian manufacturer of heavy industrial machinery who told me that they can get to plus minus 10% of the market value of a product by just considering tonnage. Now you've estimated market value. The question is, does it make commercial sense for you to produce and supply this product? And if so, on what terms? To determine this, we need to consider profitability, of course, but not the profitability of the product. The fact is, profitability is not an attribute of a product, it's an attribute of the organization that produces that product. So the specific question we need to answer is, if we supply this product at the price that we believe represents market value, does it cause our organization to become more or less profitable? We begin by calculating what's called contribution margin. Contribution is market value minus totally variable costs. Totally variable costs are things like raw materials, transport, and commissions. Direct labor is not a totally variable cost because it's simply not totally variable in the modern production environment. Contribution margin is important because it's the portion of the sale price that has the potential to make a profit contribution. Okay, so here's where the real work gets done. It's here that we need to determine whether or not we wish to pursue this deal, and if so, on what terms. The first thing you'll notice is we're not calculating a single price, we're generating a cluster of prices. We acknowledged earlier that our estimation of market value yielded a probability distribution, not a fixed point. For this reason, we're going to generate a set of prices, each with different conditions attached. These conditions might consist of different product features, different service commitments, or different delivery lead times. By generating a cluster of prices, we increase the likelihood that we'll win the deal, and we also provide salespeople with multiple parameters for negotiation rather than just price. But I've skipped the difficult part. How do we devise and price that cluster? In order for me to show you that, you and I first need a shared understanding of profitability. I'm pretty sure, like most business people, you know the formula for calculating profit in arrears. What you might not know is that this formula is no use if you wish to estimate future profits. If we're concerned with the future, your organization's profitability is the difference between two rates: the rate at which it generates contribution margin and the rate at which it accrues operating expenses. This means that if we assume a business has its operating expenses under control, to increase profitability, it must increase the rate at which it generates contribution margin. With this in mind, we can set about devising a set of options that each increases, or at the very least maintains, the rate at which our business generates contribution margin. Now, you might be tempted to ask, doesn't every order increase the rate at which a business generates contribution margin? And the answer is no. Most businesses have finite fulfillment capacity. This means it's possible to win an order that generates contribution margin, but that displaces another order that would have generated greater margin during the period under consideration. Here's a simple example. Let's imagine we're a machine builder, and in February, we're on track to deliver a customer order that will generate $30,000 in contribution margin. However, in early February, a salesperson wins an order for another machine that'll generate $10,000 in contribution margin. The only catch is the customer wants it in that same month. If we squeeze the $10,000 machine into the production schedule and it delays the fulfillment of the $30,000 order, then we've reduced the rate at which our business is generating contribution margin during the period under consideration. In this case, we might have been better off having our salesperson offer their customer a lower price conditional upon an early March delivery. This example suggests a general approach to the generation of our set of commercial options. The critical point here is that we should consider the load the proposed order will place on our fulfillment capacity during the period under consideration. You want to identify a set of options that are both reasonably appealing and that will make a positive contribution to your organization's profitability if accepted. The result is that your potential customers presented with 2 or 3 options, each with a different price and a different set of conditions. The result of this approach to pricing is that you're trying to generate as much contribution margin as you possibly can for every dollar of operating expense to which your organization is committed. The final component of our pricing framework is the process of ongoing improvement. We accepted earlier that this framework is non-deterministic and that it's reliant, at least in part, on subjective inputs. It should be clear that both the estimation of market value and the creation of commercial options rely on a number of assumptions that need to be tuned and ultimately updated as market conditions change. These assumptions need to be documented and they need to be reviewed periodically either by a pricing specialist or by a committee if your organization is not large enough for a specialist to be justified. You now understand the Ballistix value-based pricing framework. It's no more complex than traditional cost-plus pricing, but it's radically different. Whether or not you should adopt a value-based approach to pricing boils down to your position on the origin of prices. In other words, what I'm suggesting is that it isn't possible to conclude that the market, and not individual companies, sets prices, and that cost-plus pricing is appropriate for your organization. Only one of these conclusions can possibly be true. Let me answer the 3 most common questions I get about value-based pricing. The first is, what if we have set prices rather than quoting on demand? Well, the process for determining your prices is exactly the same. It's just that you do it in advance rather than on request. And in some cases, you'll apply the process to sets of products rather than to discrete SKUs. In a perfect world, you'll retain as much flexibility as possible. In industrial sales, a vendor will have a standard price list, but those standard prices are modified for different customer sets via a discount matrix. The airline industry is another perfect example. Although prices are set, they're tuned dynamically, meaning that you can sit next to another passenger who's accepted a different set of conditions in exchange for a very different price. The second question is, what if I buy, mark up, and sell commodity products? Don't I have to price on a cost-plus basis? Well, actually you don't. A grocery store is a perfect example of such a business, and we all know that they price milk and eggs aggressively because they're price sensitive, and then they put them at the back of the store, so you need to push your cart through aisles full of higher markup products just to get to them. The third question is an interesting one. If a company invents a new or a materially different product, doesn't it then set the price? Well, yes and no. If an organization has a highly differentiated product, then it has greater pricing power. But this pricing power will dissipate rapidly as competitors enter the market, as they always do. Now, if this organization attempts to exploit its pricing power by setting high prices, it'll create a greater incentive for competitors to enter the market. This means that if you invent something new, you might want to price it at what you expect its value will be in an efficient market and minimize the incentive for new entrants. Now, I'm sure you have additional questions. If you do, just add them to the comments and I'll get to them in a moment. But first, I have an offer for you. It's free, so you can put your checkbook away. I'm offering to run a 90-minute workshop for you and your leadership team. The objective will be to figure out how to apply the Ballistix value pricing framework within your organization. In particular, we'll zero in on how to estimate market value and how to devise that set of commercial options. No fluff, no sales pitch, just you, me, and your leadership team rolling up our sleeves and solving difficult problems. If you like that idea, just write the word workshop in the comment section. If you'd rather keep it on the down low, then you can connect and message me either on LinkedIn or X. Hey there, how are you? That was intense. I promised you that at the beginning. It's fairly dense subject matter, but it's important, super important. I have a feeling that pricing is the root cause of a lot of our clients' problems, and not just our clients, other organizations I interact with. And I think if you're dedicated to changing people's minds in your organization, pricing is probably where you should start. Now, I'm happy to take and answer questions, but I need to wait here for a moment because we have about a 40-second lag in the stream here. So I'm just waiting for your questions to appear here in the comments. I did answer 3 questions in the presentation itself, so maybe if I've done a good job, they're the only points of contention that I raised in the presentation, but I doubt that that's the case. Let's see. Normally with these events I get a flood of questions. One point of clarification, I talk about the Ballistix value pricing model. I don't want to infer that Ballistix invented value pricing. We simply created the framework that I showed you in this presentation. If you go to Grok or ChatGPT and ask about value-based pricing, you'll see there's all sorts of methodologies. Some of them very complex, some of them quite mathematical. I think sometimes unnecessarily so. Any suggestions on finding market pricing data? Okay, so I think there are 2 sources of data. It's interesting to use selling your home or a business as an example. If you went to a realtor, if a realtor visited you because you were thinking of selling your home and you asked them, what do you think my home is worth? They would be making an estimate primarily based on what they call comps. In other words, comparable sales in the same market space in a similar date range. And I think comps is the best way of estimating market value. So you can get comparable sale data from 2 places. From your own database, you can see the opportunities that you've won historically and the opportunities that you've lost historically, plus competitors, competitor information. I would start actually with competitor information because it's easier to be objective when you're looking at competitor data. So look at the value of other transactions, and possibly, if it's not visible, call folks who have purchased your competitor's product and tell them what you're doing and ask them what they paid for it. I think the most important thing is to develop your intuition, and the only way to develop your intuition is to submerge yourself in data. So sometimes executives say to me, well, we have no idea what market value is, and my response is, well, I wouldn't expect you to because you haven't bothered to to immerse yourself in this data. So either you or someone else in your organization needs to first apply some effort to figuring out what are things selling for. How to deal with CFO and financial controllers inside your organization. Yeah, this is a great question. There is nothing that I've said in this presentation which, in my experience, a reasonably well-educated and open-minded accountant or CFO is going to disagree with. They won't question the logic, they will question the practicality of the logic, in my experience. Most of them, when they studied finance, learned about the idea of a constraint, the output of a system being determined by the constraint. It's just that it wasn't of much use to them for two reasons. A, they don't have control over operations, and in most cases, the organization in which they work are chaotic, meaning that the bottleneck moves or the constraint moves from location to location. It's very hard for them to calculate the impact that a particular job, if you win it, will have on the profitability and the time horizon under consideration. And I think that means that, so I think convincing a CFO or financial folks of the theory is not difficult. That's easy, relatively easy. The challenge is convincing them of the practicality of it. And convincing them of the practicality of it means that you need to get finance and operations to work more closely together, and you need to formalize the relationship between sales and finance and operations. I think that the slide that I showed where you had a price being calculated using the cost plus method, and then calculation, and then having it changed via negotiation. I think that that's very messy, and the financial folks in your organization end up having kind of an adversarial relation. You end up with a Mexican standoff. I think that the value-based pricing model is a solution to the practical problem. If you insist that you formalize the setting of prices and the negotiation of prices, and insist that those parties play nicely together, it's not easy though. I referenced scar tissue in the presentation. In a lot of organizations, there is a lot of scar tissue that's been built up over the years, where finance has been fighting with sales. And maybe other parts of operations as well. So it's a big challenge. I think that pricing, though, is a good place to start. I think if you want to get rid of the cost-based mindset, pricing is probably ground zero. So is it going to be difficult? Yes, but this is the place to start. And I think that where pricing is concerned, there's oftentimes a lot of money being left on the table. And that's where to start. It's not that you want to reduce prices, it's that there are massive opportunities to earn additional money that your existing pricing framework is preventing you from exploiting. And that means that maybe 60% of products get priced slightly cheaper and 40% get priced significantly higher. Maybe that's the way to attack it. Tim asks, some of our competitors go off market and say, whatever my company offers, we can offer 20 to 30%. How do we deal with that? Well, I think that you want to be negotiating not... So what customers like to do, for obvious reasons, is to set up a bidding war where you have absolute parity in the offering, and the only parameter left to negotiate is price. It doesn't make sense for you to allow them to do that. What you want to do, and this is the reason for suggesting that you present multiple prices, is tie pricings to different configurations of your product/service offering. And put yourself in a position where you're offering something that's materially different from what your competitors are offering. The first example that springs to mind is we do some work with organizations that sell big projects. Maybe they're technology projects. And, customers have a tendency to go to vendors and say, give me a fixed price for the whole thing. Our advice a lot of times is to say, give them a fixed price for the deterministic component, the stuff that can be forecast in advance, but the non-deterministic component, the ongoing services, refuse to quote a fixed price for that, quote a monthly fee on an until further notice basis, so that the fixed price component is very low, and the monthly fee, the clients get to choose their own adventure. They can cut the cord as soon as they're happy as soon as they're happy with the deliverable, and help your clients to understand that the better they resource the project, the sooner they can cut the cord. Now, if you present a proposal like that, your customers are no longer comparing apples with apples, and they have to sit down and do their own calculus. So avoid a situation where you allow your customers to compare apples with apples, if you like. Well, that's the last question as I speak. I'm so glad I had some questions here. Thank you so much for attending this event. If you didn't catch all of it, it'll be available to watch as a replay, and I will continue to answer questions in the comments either here or on YouTube. It'll probably be available on both locations. Thank you so much for attending, and good luck changing your pricing framework inside your organization. All the best.